Let's welcome in our next guest. Rohit Agarwal of Kotak Life Insurance is now joining us. Rohit, there is always this argument between liquidity and valuations. Where do you stand? Are valuations expensive but liquidity will drive the markets higher?
Hi, good morning. Well, valuations are not cheap for sure. However, if you look at liquidity, we do not buy the argument that liquidity only drives the market. At the end of the day, the job of a fund manager is to pick stocks which offer value. The ever-going argument that there is liquidity and hence the stock prices are going up may not necessarily hold true. If you actually look at the Nifty, it's only 8 of the Nifty 50 stocks which are at all-time highs. So that tells you that even though there is liquidity around, it is not that all the stocks are going up. It may so happen that there is polarization in a certain sector or sectors, and some of the sectors are loved, and at the same time there are sectors which are unloved. At these times when the liquidity is higher than normal in the markets, what you tend to see is that most of the managers or most of the asset managers tend to gravitate towards sectors where the earnings visibility is a little higher than what the whole market earnings visibility is. Hence, you have seen that some of the private banks or some of the cement companies which have actually come out with numbers which have barely met expectations or maybe a little below expectations, the money is actually thronging onto those stocks. At the same time, some of the IT stocks where the numbers have been again below expectations, but at the same time, you're not expecting earnings acceleration to happen. What with the US laws and also with rupee appreciating, you have not seen many buyers or takers for such kind of names. And hence, when you talk about valuations, there is a dichotomy and there's a wide divergence between the valuations that different sectors command. And I think this is more temporary in nature, where when things settle down, there will be some equilibrium which will be formed. And there will also be some value buying which may emerge in sectors which are maybe 8 to 10% kind of growth rates as of now, but they are significant free cash flow generating and high ROC businesses as well.
Right. In terms of, let's just talk about the cement pack, as you said, and not only about what's happening in the cement sector. Just wanted to understand, do you think markets have become faster? So something like a ACC was up 7%, Ultratech was up 4%, even Grasim, which is a holding company of Ultratech, reacted on the very same day. So that's what liquidity does. It doesn't give you time to react.
Yeah, that is one aspect of liquidity which we do ascribe to. That whenever there is an opportunity or a window of an opportunity being offered, it will get lapped up very quickly. That tends to happen when there is a lot of liquidity floating around. But we again wish to reiterate that at the end of the day, it is earnings which will matter. If earnings do not come, this liquidity will wane. This will go away. There may be liquidity because of X reasons. There will be reasons again for which we will only be talking as to why liquidity is evaporating. One of those reasons always is earnings. If earnings do not materialize, liquidity can never keep supporting the markets beyond a point.
Right. Also, when you compare it to 2007 or 2006, the earnings cycle was pretty strong. Now one would say that earnings cycle is yet to take off. So the only thing that can happen on earnings is positive. Either they are in line, slightly lower, or they are much above estimates.
Yes, we do ascribe to that. And that is the reason we believe that the markets have not corrected as much as market participants believe. And even if there are corrections, they have been more intermittent and all of the corrections have been bought into. We actually believe that something like this is actually going to keep happening. And you will see market participants actually buying on dips rather than selling on rises. Unless, of course, there is a global event of a nature which forces you to change your view. Now, what we are trying to say, as you rightly pointed out, that in 2007, we had already seen a 2003 to 2007 kind of rally where the earnings had gone up, the markets had gone up, and markets were extrapolating earnings into the future by 25-30 times. If we look at the current cycle, the markets have gone up. When we say markets have gone up, if we actually look at the Nifty IRR in the last 3 years, Nifty has given an IRR of 8-9% only. It's the broader market where the buoyancy lies. At the same time, the earnings have not kept up the pace and they have grown at about 5 to 6%. However, if you look at the future, currently none of the market participants are expecting FY18 earnings to be 25-30%. Currently they are expecting somewhere between 15 to 17%. Although there is a caveat that for the last 3 years, we have started the year doing the same, and we have ended the year somewhere around 5 to 7%. So there is hope in the market, but at the same time, since there is a base formation which has happened, people are more hopeful that this time around earnings will actually accelerate rather than decelerate. One of the measures, that's why what we look at is price to book and not necessarily price to earnings. Now, price to book is a measure when earnings are not happening, but it also gives you a measure because there is a base through which it can take. Now, we have done some historical analysis, and our analysis suggests that anywhere between 2.5 to 3 times book trailing, if the market is bought into for the next 3 to 5 years, there's a decent 12 to 15% upside CAGR for the markets which has been seen. Of course, history need not necessarily be extrapolated and need not necessarily repeat. But this is what we have seen happening. We do believe that for the next 3 to 5 years to 7 years, an earnings growth of 15% for the market in general as a whole is entirely possible. At the same time, again, I would like to put a caveat that even if Nifty earnings are not the same, the broader market earnings may still be 15%. And that is something where a stock picker's role, that is where people like us come into the fray, where you would be able to identify companies which are growing at more than 15%. You will be able to identify sectors which are beneficiary of some theme or some happening, and hence they will benefit and come out winners in the longer term.
Right. In terms of broader market earnings, do you do any valuation matrix for broader markets, or it's a case-by-case basis? Can you say that mid-cap valuations are in a bubble territory, what some of the strategists are suggesting?
We do track that valuation. Our model, which we follow currently, suggests that it's in a neutral zone. We again follow a kind of price to book model where we take the large cap into the numerator and mid cap into the denominator and try to come out with a value and assess if the mid caps are in overheated zone. Even though we have seen the mid caps rally more than the large caps, we have to bear in mind that the mid cap earnings have also been better than the large caps. And that tends to happen in an economy which is on the cusp of a turnaround. There will be new sectors, there will be new companies which will come and they will lead the market. They are today's mid cap, but they can be tomorrow's large cap. Even from mid caps, from large cap, we certainly believe that India has a long growth potential. Just to give a corollary, why don't we think that an Indian financial lender can be a $200 billion market cap? What stops us? We are 125 billion people, the largest in the world. And why is it that the largest market cap of a banking stock in India is $30-40 billion? It can be $200 billion. Can there be a retail company in India which is $50 billion? The answer to that is possibly yes. The market participants are in the process of trying to identify which will be that company. Hence, it is not just identifying that company, but at the same time identifying the sector which can lead that kind of market wealth creation in the future, which will lead the whole investment community towards that.
Right. Say if earnings have to recover for the Nifty pack, as you said, underlying mid-caps would still continue to do better. The earnings growth on a YOY basis, the matrix over there would actually tend to look much better.
We actually think so, that the broader market earnings will be better than the Nifty earnings. One of the primary reasons, if we actually see, is Nifty is also very heavy on commodities and some of the cyclical sectors. So even though you will see earnings coming from them, they are low PE sectors. Whereas the broader market is a much better representation of what's happening in the economy. And that's where the delta or the change is likely to happen, in our opinion.
Right. In terms of, housing finance companies or banking stocks that have declared numbers, they still point out that there is a lot of growth opportunity for these names and they would continue to grow going ahead.
Absolutely. If you look at the numbers that have been reported as of now, one of the biggest private sector lenders still continues to grow at very high teens. That tells you that there is enough growth opportunity which is available in the market. At the same time, in every sector, you have to be very careful and choosy in terms of what's happening. If you see what's happening in the lending sector, most of the government-owned companies currently do not have the wherewithal or the balance sheet to lend very aggressively. When that happens, the private sector or even the NBFCs, which is only 30% of the market, is able to pick their credit, is able to choose what kind of lending they wish to do, and there are enough pockets of excellence, as they call it, or there are pockets where they believe they can grow faster than the market, and they will continue to do that. And hence, we believe that is one sector where you will continuously see some of the private sector guys, be it private banks, be it NBFCs, continuously outperforming the larger peers and growing even with lesser risks to asset quality in the longer term.
All right. What about, since you said that mid caps earnings growth has been better than the large caps. So at this point, if somebody had to invest, would then investing in large caps be a better bet? Do you think mid caps may have been overheated?
See, it's very difficult to call the point where the mid cap will correct a bit versus the large caps. If you look at the last 10, 15, 20 years history in the Indian markets, the general earnings trajectory is 300 to 500 basis points higher than the large caps. That does not necessarily mean that everyone invests in mid caps, because there is a risk appetite, there is variance, there is volatility which will happen with the mid cap space. So any event or shock that may happen to the economy or the country, the mid caps will bear a larger brunt, because the valuation parameters there tend to contract or expand exponentially depending upon the market view of the participants. So even though the mid-cap earnings growth trajectory over the longer term will be higher than large caps, there will be enough people who will be allocating enough money to large caps and some money to mid-caps, depending, of course, upon the risk appetite. It's very interesting that you bring along that point. And one of the reasons we believe that mid-cap funds or mid-cap is outperforming is the Indian diaspora. If you look at the Indian diaspora, people aged between 18 to 35, that's more than 30% of our population. Now, that's the largest in the world. If we do some historical analysis, which we have done, it all started with Japan and then moved on to Hong Kong, Singapore, Taiwan, and lastly China, where the working age population, if it was between 18 to 35 years, there was a huge explosion in some of the mid-cap names, simply because this kind of population leads to better consumption, better job opportunity, better GDP growth, and better savings rate. And this kind of population tends to consume not the traditional goods, but more discretionary, a better car, a better bike, a better household appliance, and all of such things. And hence we believe that India's demographics, which we actually believe even till 2040, this demographics of India between the age of 18 to 35 will be the highest population in the world, will continue to drive consumption. At the same time, we do need investment. So we are very bullish on some of the consumption themes which are emerging, where some of the companies are especially targeting where the penetration of that category is very low in India. We are not talking about the general soaps category or the shampoos category, but we are talking about some of the categories where the penetration is very low and where it is discretionary. But the working age population from 18 to 35, which will actually be the wage earner, and they are actually 40 to 50% of the wage earning population, that is where you will see a lot of growth coming in.
Can you give us an idea on what kind of discretionary consumption you're talking about, where there's low penetration? Maybe if not stock names, but sectors or the kind of consumption, low penetration themes that exist?
Absolutely. If you look at India, apart from the big metros, there is still an electricity problem. Now, if you see in the last 2 to 3 years after the government has come in, there has been a huge impetus on providing electricity even to the villages. Now, this is a process which has started. It is happening. Things are improving. After a couple of years, we'll see probably a lot better situation on the ground. When that happens, we have to just start thinking, what will happen to that rural lady in the urban on the rural side when she gets electricity? Currently, they have a 6 to 8 to 10 hours of electricity outage. When that stops happening, what will they do? They will probably put a refrigerator, they'll probably buy a TV, maybe an air conditioner, maybe a fridge, all of these things, and not the soaps and shampoos. So these are some of the categories where we believe that the penetration story is way off, and there's a long way for India to go there. When electricity reaches people, there are many things that will come in demand which we never thought will be consumed by a certain sector or segment of the economy.
Basically, you like white good makers and electric good makers, right?
Well, we do like them, At the same time, we also believe that given the thrust which is there on housing, there will be a lot of themes which will emerge from the housing itself. It may be in the form of housing lenders, or it may still be some of the items which go into making a house, things like cement, tiles, plywood, all of things that go into actually making a house will also be things which will be in demand where the penetration is pretty low. Again, rising incomes, rising wages will give rise to aspirations, and that will lead to some of the discretionary consumption which we have not seen in the last decade or so.
All right. You also mentioned that India's demographics are so placed that over the next 30 years, we see higher savings as well. So would you like some of the lenders on this theme that, financial inclusion will just increase penetration of financial products? How would you pick amongst the lenders?
So in lenders, as I talked about, we certainly like the private banking space and some of the private NBFC lenders. At the same time, you will also see people who are into exactly the same business that we are talking about, which is into the savings business. People who have good asset management companies, who have good insurance companies. Let's bear in mind, all of these kind of businesses are basically operating leverage businesses. There is a certain amount of fixed cost, and it takes a pretty decent amount of time for these kind of businesses to break even. But the beauty of these businesses is, once you break even and once operating leverage starts to kick in, with hardly any incremental capital deployed, the returns on capital employed are humongous in this kind of businesses. So we are also focusing on some of these lenders, not just lenders, but actually people who are savers and who are the financial institutions who invest or save people's money and invest their money into different avenues where you will see enough market wealth creation, simply because there will be enough money made by these guys in the longer term.
All right. So you like consumption names, you like the lenders as well. What about the PSU banks? What future do you think they hold? We're already seeing some sort of consolidation coming in when it comes to SBI. Do you think the prospects for PSU banks are better from here on, given the reach and the penetration they have?
Well, that's a tough one. Why I say so is, the reach and penetration story has always been there with the PSU banks. But it is not about reach or penetration. Reach or penetration can help you even just to a certain extent. What we need is that the PSU banks need to reinvigorate themselves or reinvent themselves in terms of technology. Currently, we believe that they are in a consolidation phase, not just in terms of consolidation between some of the PSU banks, but also consolidating their balance sheets. If you look at most of the PSU banks currently, they do not have the wherewithal to go and lend out very aggressively. It is actually good for them, in our opinion, for the long term, but it will take a year or two for that to settle down. Why is it good for the long term? Because since you don't have capital, currently you are not concentrated on lending, and there is no lending which is of a nature which may give you some headaches in the future in terms of gross net NPLs. What they are doing right now is trying to get their house in order. They are focused on efficiencies, they are focused on collections, they are focusing on some of the other costs that go into building their business. Now this will take 1 to 2 years, but after 1 to 2 years, and maybe after a package which is being talked about between the RBI and the government, how to bail out the current NPL situation in the banking system, where the majority is held by the PSU banks, we will probably see a better days ahead for them. But in the meantime, they will have to take this pain, and this pain probably will be good for them. And once and for all, after this cleanup, we believe and we hope as market participants that they will have a brighter future.
Do you think this entire recovery process may get prolonged? Do you think that resolution of the NPA problems is going to be that easy? Because the load is too big. The mountain of NPAs is quite large. Their capital is not enough. They're tapping the markets of capital is not working for them, and the government will have to infuse large amount of capital for PSU banks, which it seems a little reluctant to do. Do you think it will get prolonged, this entire cycle?
Well, it's tough, but it's certainly doable. The logic is, it's not just about capital, and that's where we believe that every time there is an issue in any sector, all we think is government should give the capital, do the cleanup and move on. And that's why we believe this time things may be a little different. We hope so. The reasons are, every time you give capital, what you're doing is telling them that you can go and keep doing the same things. Even though we believe that there are better checks and balances in place, but it doesn't happen. What is the need of the hour is that for the whole chain to take a haircut and then move on. It cannot be only one party which takes the haircut all the time and moves on. It also needs to be the promoters who have borrowed who need to take a haircut. Now in India, that is not something which has happened a lot in the past, and that's what we believe needs to happen, and that's what we hope will happen for a brighter future, where the promoters, the lenders, the suppliers, everyone takes some kind of a haircut, and then we start on a cleaner slate and move on. When all the parties take a haircut and decide to come on the table and decide to come on common grounds, the probability of the mistake repeating in future at the margin goes down, and that's why we believe it is taking longer, and that's why, since the magnitude of the problem is very huge, it is taking longer time for it to get solved, and we hope certainly that it will get solved in the betterment of the country as a whole, where all the participants will have equal rights and they will take equal cuts probably and move with a cleaner slate.
All right, so that is your view on lenders, and you like consumption and you like the financials. Now can you tell us amongst the other sectors, say metals, which have done very well over the last 12 months, do you think there's still opportunity for investors to buy? There is this talk about this whole reflation trade driven by the Trump rally. Do you think that metals are good for more? Would you view them positively?
Well, on the metal sector, we believe that it is not a sector which creates great shareholder value in the long term. If you look at the different cycles which have happened in the metals, they do not tend to give you a great return over cycles. However, if you can time the cycles very well, it will give you very good returns. At this point where metals stand, where versus last year there has been a decent rally, where some of the names have actually gone up 2 times to 4 times, we do not necessarily think that there's a lot of steam left in metals. There may still be some upsides depending upon, of course, as you said, reflation trade if it happens. But if you see in the last month or so, actually it is not happening because some of the commodity prices in the world have started to soften. Now it's a very difficult call as to where are the commodity prices headed. And hence the metal stocks which basically react on the commodity prices, it's a very difficult call to take. We would rather refrain from sticking our necks out on the metal rally from now on, and rather stick to some of the fundamental stories we believe are in good shape. We believe the domestic Indian story, some of the companies which concentrate mainly on the Indian domestic story are the ones to bet on. Globally, metals as a sector is very difficult to call. Rupee is appreciating. We don't know what is going to happen to the prices of the metals. And we do not actually think that the price of the metals are going to see a 10 to 20% uptick, barring maybe a couple of commodities here and there. So our view on metals would be not necessarily to get into them in a big way.
All right, so you think they may have run out of steam. What about stocks from the cement space, which have seen a big up move the last couple of sessions, as well as steel? While steel prices may be determined by what happens globally, if demand picks up from, say, affordable housing, both steel and cement will be in demand. Would you then view steel differently, and what's your view on cement?
Well, we view cement and steel differently. The one primary reason is steel can be imported, cement can't be. Cement is made within the country and consumed within the country. Whereas in steel, even if there is demand, there is enough supply across the world for you to consume it at not a very different price. Even if Indian demand grows at 10-15%, it is not going to change the world steel prices by much at all. And hence, if Indian steel consumption or demand cannot be met by some of the Indian producers of steel, there is always an option to import steel. Of course, most of the steel is imported in the HRC format and not in the cold rolled format. But there will be enough converters or conversions available here. So to answer your question, we view these two sectors pretty differently. And if there is a housing boom, There are other ways to play and not necessarily steel. Even though some of the steel manufacturers in India may be a beneficiary, so some of the market participants may be playing that. But if there's a housing boom, there will be a cement demand as well. There will be a paint demand as well. There will be a tile demand as well. There will be a plywood demand as well. So some of these themes can also be played if there is a big housing boom in India.
All right. What about some of the defensive bets, traditionally seen as defensive bets, pharmaceutical and IT? We've got IT earnings coming in for the fourth quarter and they really are looking bleak. What would you do with these two sectors?
Well, as I said earlier, there has been a polarization, and that tends to happen especially in terms of higher liquidity and not necessarily related to earnings. The IT earnings have been a little short of expectations. When I say little short of expectations, maybe 1 to 3% lower than what the market expected. But this sector is so micromanaged and so micro looked at that any deviation of plus minus 2% leads to such kind of movement. Having said that, if you look at the FY18 outlook, I'm not talking about a 3-year outlook on IT, simply because IT is more of a quarter-on-quarter and a year-by-year thing rather than a 3-year or 5-year story, where it is very difficult to call out what will happen in the 5 years. Even if we have to call out what will happen in the 5 years, what we certainly see is there is some kind of destruction happening in the way the business is run. There is so much of thrust on digital. If you look at most of the CTOs in the world, all they come and tell you is, my budget is flat and I want X percentage higher work done for the same kind of budget that I have. What that says is, there is kind of creative destruction that needs to happen within the IT space, and hence the growth rates of Indian IT is probably single digit. Now, when the growth rates are going to be single digit with an appreciating rupee, there is probably going to be an impact on margins. Some of the companies may be able to manage the margins better, but unless the market sees a lot of growth coming back, they are unlikely to throng to such sectors. Having said that, when you see market corrections, these stocks will tend to outperform. I think currently they are in a phase where they are reinventing their businesses, or some of them need to actually do it in a way where they can reinvent and get better, leaner, better, meaner, and change their business models. But in the meantime, most of the IT companies have resorted to capital structuring, which is something that all of the investors had been wanting. So they are increasing the dividend payouts. They are anywhere between 50 to 100% of their earnings is being given out as dividends now. What this tell you is, maybe there's a floor to the prices. So you will probably not see the IT companies maybe falling another 10-20%, but it may so happen that if the market goes up, they continue to languish or maybe participate to a lesser extent and underperform the market if the market goes up. Now, the pharma sector is a different sector from the IT sector, where even though there's a little impact of the rupee, it is more bottom up, and there are individual stocks. There are stocks in pharma which are at all-time high, and there are stocks in pharma currently which are at their all-time lows. So basically, it's more company-specific, stock-specific, but the sector as a whole had its challenges in terms of manufacturing practices. Now, we believe that in the next 1 to 2 years, some of the manufacturing plants that these pharma companies have will probably have complied with all that the US regulator wants. The other challenge they are facing is that there is a dip in the generic pricing in the US. Now, a 10% cut every year in the generic prices does hit the bottom line of the Indian pharma companies. To make up for that, you need to come out with new ANDAs, new filings, and new approvals, and then you maybe need to have a blockbuster drug to make up for it. In the past 5 to 7 years, what was happening was, every year, most of the bigger pharma guys, which have close to $1 billion in the US, used to get a blockbuster drug every year, which used to make up for the loss of generics pricing every year. Even though the generic pricing was only single digit of 2 to 5%, that has increased from 5% to 10%, but the blockbuster drug has disappeared. Now, what that leaves us is the multiples of 18 to 24 times, but the earnings are more like 15%. So I think there's a time correction which is happening in pharma, maybe a little bit more, but in the pharma space, we do believe that there are certain stocks and there are enough companies which offer value, and on a bottom-up basis, we cannot brush pharma on a top-down approach, it has to be bottom-up. But in pharma, we are selective, and we are not a huge underweight in pharma. We do hold positions, and we are selectively buying pharma.
All right. Thank you so much for joining us on NDTV Profit and sharing with us your views on the markets and the stocks and sectors that you like.